Why should I invest? But why should I invest? My father is one of the hardest working people I know. Growing up, I remember him juggling a factory job making cable ties and a side hustle mowing lawns just to support our family, me, my mom, and my 3 sisters. He'd stash away any extra cash in a shoebox and a bank account with barely any interest, hoping that one day he'd have enough to leave the factory behind. When my uncle decided to invest in stocks, my dad thought it was way too risky. But what he didn't realize was that keeping his savings untouched was just as risky. See where this is going. Every year, inflation was quietly eating away at his savings. It's just how money works. More cash in circulation makes each dollar worth less. So despite all his hard work, he never saved enough to quit the factory job. The idea of my own money losing value over time terrified me. So I made it a priority to invest from an early age. As a result, not only have I outpaced inflation, but my investments now grow by about $17,000 a week, all on their own. Over the years, this has made me millions. I'm not a financial advisor, but I am someone who's lived through this and made it work. That's why I'm making this video, the kind of guide I wish I had when I was younger. The question is, how can I make money investing in stocks? To make money, the first step is beating inflation. Historically, inflation has averaged about 3.8% per year over the past 60 years. That means if your savings aren't growing by at least that much, you're actually losing money. Ideally, you'd have a savings account that gives you an 8 to 10% return annually. But those don't exist. The good news? You can get those returns by investing in stocks. A stock represents ownership in a company. When you buy one, you become a shareholder. And there are 2 main ways to make money from stocks. Stock price growth is the first way. If the stock's value increases, you can sell it for a profit. Dividends. Some companies pay shareholders regular dividends, meaning you earn money without selling your stock. The real magic happens when you invest in multiple stocks that grow at around 10% per year. Thanks to compound interest, your returns multiply over time. Let's see an example. If you invest $250 per month at an 8% annual return in 42 years, you'd be a millionaire. Keep investing for another 10 years, and you'd have over $2 million. Investing more speeds up the process. Of course, stock returns aren't guaranteed, but this has been my experience. So, the real key to building wealth is time. Which brings us to the next question. When start investing has a short answer: as soon as possible. The earlier you start, the more time your investments have to grow and compound. It also allows you to take more risks, giving your portfolio time to recover from stock market crashes, which are inevitable. However, life isn't always straightforward, and certain things need to be taken care of first. Here's how I'd structure it. The first is pay off high-interest debt. If you're paying 15% interest on a credit card, there's no point trying to earn 10% in the stock market. The second is build an emergency fund. Save 3-6 months worth of living expenses so you're not forced to sell investments in a crisis. Once those steps are done, you're ready to invest. If you're under 18, ask a parent to open a custodial account for you. This gives you a huge head start in the future. Now, you're probably wondering, A typical investor will tell you as much as possible, but I have a different take. I built most of my wealth through businesses and used the stock market to grow it over time. I've also had an amazing life, flying planes, racing cars, competing for my country, and traveling the world. If I'd invested everything into stocks, I would have missed out on a lot. So my advice? Invest what you're comfortable with. If you want a guideline, the 70-20-10 rule works well. 70% for living expenses, 20% for investments, 10% for fun. People who follow this tend to build wealth while still enjoying life. But how do I buy a stock? There are plenty of investment apps out there. The key is opening the right account. Depending on where you live, you'll hear different names. USA Roth IRA, UK Stocks and Shares ISA, Canada TFSA, Australia Superannuation. These accounts let you avoid paying taxes on investments. Another great feature is fractional shares, which let you invest with as little as $1. This wasn't an option when I started, but it's an amazing way for beginners to learn. My favorite investing platform is Trading 212, which also lets you practice investing with virtual money. Now that you know how to buy stocks, there is the consequent question. Of course you want the best stocks. There are two main ways investors predict stock prices. Technical analysis is the first, looking at stock charts and patterns to forecast price movements. Fundamental analysis is the second, studying a company's financials, leadership, and brand strength. As a long-term investor, I focus more on fundamentals rather than short-term price swings. I buy stocks intending to hold them for years, not days. However, the majority of my investments aren't individual stocks. They're index funds. But what is an index fund? An index fund is a way for regular investors to outperform most professionals with minimal effort. Think of it like a sports league table. The best performing companies move up, and weaker ones get replaced. A prime example is the S&P 500, which tracks America's 500 largest companies. Instead of picking individual stocks, you can invest in all 500 at once through an index fund. Historically, the S&P 500 has returned 8 to 10% annually. No one has ever lost money if they held it for 20-plus years. Most professional investors underperform compared to index funds and still charge high fees. Index funds, however, are passively managed and have fees as low as 0.02% per year. Here are my top 3 index funds. S&P 500 index funds, good for long-term growth. For example, VFIX, VOO, VUSA. Total stock market index funds, more diversified, for example, VTSX, VTI, VWRL. Emerging markets index funds, exposure to high-growth economies, for example, VIX, VFEM. The real risk, not investing at all. Even if markets crash, history shows they bounce back. To manage risk, you can mix in some bonds, which are more stable investments. When you're young, the biggest risk is not taking enough risk. For young investors, there are only 3 good reasons to sell. You need money for an emergency, but hopefully you have an emergency fund for this. You made a bad investment. If a stock keeps underperforming, cut your losses. you've reached a specific goal. If investing for short-term goals, set a target price. But in general, hold your stocks for as long as possible. Want to learn how I pick individual stocks? Watch my videos. And don't forget to subscribe if you want to grow your wealth.